We're going to move forward. I'm going to start off today's presentation. Nathan Smith will follow, and we'll conclude with Scott Mickey. Hopefully we'll have a few minutes towards the end of this to have some additional discussion and to be able to take some additional questions. Many of us moving through this particular crisis that we're going to discuss today, which is really centered around the Ukraine and Russian crisis. Many individuals have been getting a lot of information from the news, and I've been finding different statistics being used, and so we wanted to try to clarify a little bit of what's taking place to create some context of understanding as we move through these times of changing commodity prices and watching our input costs continuing to increase. So I am going to share my screen, and so we can begin. Nathan, Scott, do you have anything else to say?
No, you're good to go.
All right, so let's get going. Hopefully, is everybody able to see my slide set? I'm going to take that as a yes. And so I am going to start off discussing.
Hey, Adam.
Yes.
Right now it's on the presenter slide. So you probably want to use, yeah, there you go.
All right, perfect. All right. Thank you, Kevin. So I'm going to start off on the real global scale here. And we've been getting a lot of questions from people. How come we just can't do this or do that? Why can't we just start tapping, putting more oil wells in, or and so there's a lot of issues between relationships between countries that are taking place. And so we want to kind of start off with some of the geopolitical issues that are out there right now. Obviously, US and NATO does not want to have a direct confrontation with Russia for fear of an escalation. We've been hearing this in the news, fear of nuclear war. We know Putin has used nuclear devices in, not what we normally think of as an atomic bomb or nuclear missile, but has used devices that are frowned upon around the globe, including biochemicals, etc., in the past, and the very recent past at that. And so, that's one issue that we're moving through presently. There's also an odd relationship between Saudi Arabia and the US. And there were some strenuous times over the past 4 or 5 years in Saudi. There's always been a kind of a love-hate relationship. And so we have some issues there. Now, some of you may remember that it wasn't that long ago, 10, 12, 15 years ago, that we saw a significant increase in oil prices and at the gas pump. And at that point in time, with our relationship with Saudi helped turn on the faucets, as it were, to begin to produce additional oil to help relieve us of some of those higher costs. And at that time, we have to remember that the relationship between Saudi and other countries as well plays a role with regards to this. Saudi does not have the best relationship with Iran. They are somewhat of enemies, and because Iran is typically backed by Russia, and vice versa, that also falls suit, which helped out in the previous round of 10 years ago when they turned down those faucets. Russia has been talking with Saudi Arabia and other OPEC nations, hoping that they can talk them into not opening up those oil faucets any further, and in fact even trying to contract a little bit if possible, which gives Russia a bit more of an upper hand with regards to that. So We have to remember that Saudi is one of the original members of OPEC. OPEC was created decades ago. I believe there were somewhere between 9 and 13 original countries that after the initial development of OPEC that quickly went in. Venezuela is presently the only non-Mideast or African / Asian member. Ecuador and Indonesia and Qatar were all members of OPEC at one time, but all within the last 3 years, all have backed out of OPEC's membership, leaving Venezuela as the only non-Mideast or African member of OPEC. And of course, OPEC controls a very large portion of oil around the world. And we'll talk a little bit about that in a few moments. So let's talk about our inputs briefly. Let's talk about where some of these items are coming from, some of these products are coming from, where do they head, etc. And so fertilizers will be first on the list. And when we take a look at potash, Canada produces 30% of the potash that's out there, followed by Russia and then Belarus, who is, for all practical purposes right now, being controlled by Russia. So if you take a look at those two countries, they're producing over a third of what is utilized globally. The US only produces about 1% of the global production of potash, and we import about 7,000 metric tons, 75% of which comes from Canada, 10% from Russia, 8% from Belarus, and 7% from other countries. When we take a look at phosphate, the top producer is China with 39% of production. The US is actually third with 10%. And we continue to import phosphates from Peru and Morocco, as well as, depending on the year, some other countries. Russia is fourth from a production standpoint with about 6% of the global production. When we take a look at ammonia for nitrogen, China is the top global producer. Russia is at 11%, the US with 9%, and we continue to import to meet the US needs, much of which comes from Trinidad, Tobago, and Canada. When we go back into the oil side of things, because that's what the general consumer presently is talking about with the gas prices, which have actually dropped over the last few days slightly, we have to understand that there are actually different types of oil. Coal is the same way. There's different types of coal, the components that it's made up of, which then goes to the production facility. Each production facility is spec'd to be able to handle a certain type of oil. And so that's the only type of oil they are able to receive. Okay. And so we have to understand that. And so that is one of the reasons why, although the US produces a significant amount of oil, we export a decent amount of oil. Some gets consumed and is processed here in the US, but we still, to be able to meet our needs, have a need to import certain types of oil to meet our own national demand. And so over the last 12, 15 years or so, we have actually seen the gap between what we produce and then the net import has actually closed over the last 15 years. Back in 07, 08, 09, it was hanging out about 50% of what we were importing what was needed. Presently, we're down to about 20% of our crude oil that is imported. In 2021, petroleum imports came from Canada, OPEC members, Mexico, and Russia. Here is a table that was pulled from the U.S. Energy Information Administration, which is part of our federal government. This is 2020 leading oil producing countries. You can see there the U.S. is up towards the top, followed by Saudi, Russia, Canada, China, Iraq, and others. Now, when we take a look at consumers, The US is up there, followed by China and then India. And as many of you may have heard some of us speak in the past, we've talked about growing nations and marketing opportunities, which is going back towards that China, India, Southeast Asia corridor. And we're seeing that through some of the consumption numbers here with oil. Natural gas. The US produces the most and uses the most. Russia produces about 25% of all globally exported natural gas and is the second largest consumer of natural gas. And China follows Russia and in third. And we've been hearing a lot about this, and this also plays a role with regards to the oil prices and natural gas prices. Plays a role with regards to the production of some of our fertilizers. And we've been hearing various stories with regards to that, and some of the data has also shown where some of those pinch points are around the nation, whether we're talking about Morocco or Northern Europe, where we see some of our fertilizer products being produced and then making its way to Europe and to the US and even into Canada. And so these are some of those things that we want to watch, is those prices. And if this Ukraine-Russia crisis begins to hamper any of this movement, and where is the natural gas and oil, who's going to replace those supplies to be able to meet our demand? And with that, these are just a few of those things that I want everybody to kind of begin to think about. If the supply of any given product, whether it's a fertilizer product, corn, or even oil, if the supply remains the same, demand remains the same, but because of geopolitics, we have decided to essentially shut off the ability to access a particular market, let's say in this case, Russia, we stop those purchases from that particular market. We still need to get the same quantity because the supply and the demand, or the demand, has still remained the same. We're just shutting off what store we're going to. We're no longer going to shop there. Okay. And if everybody starts doing that, or the majority begins to do that, that begins to create problems. And obviously we've been hearing stories, and, a few weeks ago it was, many countries getting mad at Shell because Shell had purchased some Russian oil, but it was really, really cheap. So they saw some profit line in there, some profit to be made, and that's what they did. They have, since apologized and are no longer supposedly purchasing direct from Russia anymore. But the reality is, in many cases, there's going to be a switch. All right. And what I mean by the switch is, if we stop purchasing from somewhere else, we need to purchase it in this new spot. That's going to change what they have available for them for use potentially in country, as well as continue to be able to market to those other purchasers that they normally have. And so are they going to have to go on the backside as well and begin to source some of these products from elsewhere? And so from that, until everybody stops purchasing from one particular market, in this case, Russia, then that portion is now inaccessible. So how do the markets react? And we've seen some of this pricing take place within some of these products. If we're not able to source it, and we take a look at that market, are we going to consider that supply as such essentially inaccessible globally? Do we have prices that then become volatile and begin to move up with regards to the inaccessibility of a product from, let's say, Russia, Ukraine, Belarus, and in that particular region? And so with that, I am going to step back and hand this off to Nathan. Hopefully this begins to set the stage for Nathan and Scott.
Thank you, Adam. Are you okay? You going to let me see if I can share the slide here, and we'll get going following up. All right, is that showing up? All right, good deal. So Appreciate Adam talking about the oil market and looking at the commodity wise, the Black Sea regions is an important area of production for feed grains and small grains, corn and wheat in particular. And Ukraine is a sizable producer of wheat and corn. Here's a chart showing where the wheat production takes place in Ukraine from USDA. About 97% of their wheat is winter wheat. And you can see that it's more in the southern part, eastern southern part of the country is where wheat is produced, planted in fall like us, and harvested a little bit later than us in July and August. As far as top wheat producers in the world, China as a country is the top producer, and European Union overall, though, when you add up the European Union, they're the top producer of wheat, followed by India, and then you see Russia, Ukraine follows Australia. So Russia and Ukraine certainly larger, good, sizable producers of wheat, and therefore players in the export market for wheat. For corn production, that's concentrated more in the northern part of Ukraine, but obviously you've been watching the news. All those regions are being impacted, I guess, by the war. But I think as far as corn planting, they're getting ready to start corn planting here pretty soon. And it's uncertain as to how much of normal they will be able to do with the logistics and all interruption. But and looking at world corn production, we are the largest in as far as corn production goes, followed by China, and then you see Russia and Ukraine here at 30 million tons, and Russia at Ukraine at over 30 metric tons in 2020, and really ramped it up to 42 million metric tons in 21, and Russia increased too. So those are the two main commodities. Ukraine also produces a large amount of sunflowers. About a third of that crop is exported, and they process it. Soybean oil, soybean meal as part of their exports. Again, they're a large main exporter of wheat and corn, and they're the second largest grain supplier to the European Union last year in 2021. When you look at where they go outside the European Union, they also are a supplier to Africa, Middle East countries, and Asia. So you don't see the U.S. in there, but in terms of where their exports go. Approximately 50% of their wheat does go to the Asian countries, and the other 40% to Africa, and 2% into Europe, and 2% elsewhere, Egypt, Turkey, Indonesia. Russia supplies wheat to Germany, Austria, and several other Eastern countries. So obviously the war and the sanctions and the geopolitical uncertainty, that's really played into the wheat market, considering where these exports go, and futures are in double digits now in terms of wheat price. Looking at our three main grains and oilseeds, corn, soybeans, wheat, we're looking at, for 2022, higher supplies, but also higher demand. And that's kind of been the story, and Scott will kind of talk more about that. But this was USDA's outlook forum showing production going up over last year. This was before the invasion, and then consumption expected to go up too for each one of these commodities. And I don't know that, that picture has changed some, but we still kind of see the growth in demand and some tightness in supply. As far as exporting countries, corn overall is expected production to go up over last year globally, but if you look at the exporting countries, it's still relatively tight, even with what going into 2022. And so, as tight as it's been since 2012, 2011, 2012. And if you look at Ukraine and Russia relative to the rest of the world, in the bar chart here, the green's the rest of the world, and Russia's the red, and Ukraine's blue. And obviously, Ukraine's important for wheat and corn, and Russia is largely wheat. And USDA in their March World Ag Supply and Demand estimates revised their Ukraine, Russia estimates in terms of exports, and you see they adjusted those down some. Of course, this was early, and these are just projections and due to the uncertainty caused by the war. So going into 2022, was probably expecting to see a similar type production. That obviously 2021 was a good production year, but corn, wheat, soybeans, and barley being Ukraine's main crops, and Russia, it's being led by wheat, winter wheat and spring wheat, followed by barley and sunflower seed and corn. So just wanted to show these figures and how Ukraine and Russia fit overall in the global ag commodities in the market. And while we see the futures really responding, particularly wheat, as a whole, the decrease, we'll have to just watch what their production does, because some of that production, particularly wheat, will have to be filled in somewhere else if they're not able to produce their normal size or expected size crop. So I think that's kind of the thing we'll be watching. In terms of demand, hadn't seen as much on the demand side issues as there is on the supply side. So Adam, if farmers are having a difficult time looking into fertilizer, I'm going to refer to you here on this question. If they're having a difficult time getting fertilizer, what kind of things are they looking at as far as decisions for 2022?
Well, and we have started seeing this. There's, in fact, here in South Carolina, there's some areas that I've been hearing that farmers have already been told they're not going to be able to get the quantity that they thought they had already secured. And so, there's two different aspects of this. One, which is a pricing standpoint. If a farmer doesn't feel like he's able to afford to purchase what is needed, or then if I can't access the quantity, these are some of the questions that some people are going to begin to ask themselves is, all right, well, if I know I need to put down X across all my acreage, but I'm only getting 3/4 of that or half of that, do I just put that out evenly across the acreage, or do I actually reduce the total acreage that I plant? And those are going to be some of the questions that are going to have to be worked out. And I know Scott and I have discussed this as well, and we've had this discussion. He actually was looking into some of that just yesterday. And so those of us that work with farmers are going to have to be prepared to help them through that thought process. And I'm guessing that Scott's also going to help answer some of those questions throughout his presentation. But it's those types of questions that we're going to have to be prepared to respond to. So the reality is, in some cases, in many cases, you ought to be reducing those acreage to be able to maximize what I can produce on the acres that I have the inputs for. But that being said, I'm also one that takes a cover your rear end standpoint, and we really need to push the pencil to see exactly what that's going to be, because every situation is unique.
All right. I'm gonna stop sharing here. Well,
You just switch, you just keep going on.
okay, I'm sorry. I'm gonna continue to share and switch over to Scott here. Okay.
See if I can make yours. Okay, so we're going to shift gears a little bit and talk a little bit about the 2022 Clemson University enterprise budgets. And what I'm going to do is just kind of show you some of the things that have changed since the last time we got together in November at the Outlook Conference, kind of where we are today. In looking at futures prices, you can see that September 2022 corn prices are about 21% higher yesterday than they were back in November. Soybeans are up a similar amount, cotton's up 17%, and July 22 wheat is up 30%. So based on those increases in prices, do you think the profitability of these crops has improved? Well, it would be easy to say yes if we didn't have the changes in input prices. But since November to February, which is the date of the last updates on fertilizer products, you can see that inputs such as nitrogen, using urea as an example, is up 16%. Phosphorus is up 8% compared in February compared to November, and potash was up 12%. Probably the biggest mover has been lime, which has moved from $56 a ton to $68 at 21%. And then probably the disruptor for agriculture, and the leading disruptor is probably this farm diesel price. In November of 2021, farm diesel was averaging $2.86 a gallon. And in February, it is up to just under $4, or a 40% price increase. LP gas used for drying many of the products we grow is pretty much unchanged with a 1% increase. So looking at that, you could say, yes, the profitability has declined, but it looks like the price increases probably offset some of that expense increase. So what I did was I updated the 2022 row crop budgets with these new input prices and new commodity prices. And as you can see, what's available to use for overhead expenses, debt service, and management is shown in the green bar at the bottom. So on dryland corn, we're looking at just under $300 available. Dryland cotton is $321, peanuts is $372, soybeans is $172, grain sorghum about $183, and wheat is at $246. Back on the last update of the budgets in 1st of February, you can see that prices were quite a bit less, or the returns available was less. But currently, you can see that for corn, we're better off today than we were in early February. But on cotton, we're slightly worse off today than we were in February. And as you start thinking about that, there's probably more fuel components incorporated into the cotton budgets than maybe in the corn, and that may be accounting for some of that decline in profitability. Same thing with peanuts. Peanuts is one of those crops that does not reflect a price increase since earlier in the year, because most of those are contracted and that price is set. Soybeans have improved returns, as does grain sorghum and dryland wheat. Dryland wheat's probably had the biggest change from about $70 of return available to $246 based on the new futures price. The only downside with the wheat is the fact that while futures are at $11, I think a lot of producers are having trouble getting contracts for wheat production against the July contract. The buyers seem to have shifted to September and December and have kind of capped the market in the $9 range as a cash bid. As we look at irrigated, we see a similar picture. Profitability has increased across the board except for peanuts, which again does not have a change in crop price. So as I think about this, I'm trying to think of all the disruptors that we've got going on in South Carolina right now. And I've just listed, 5 of them on the left-hand side, and then highlighted some of the things that are happening that seem to be influencing price. So with Russia and Ukraine, as Adam and Nathan discussed, it's having a big impact. Right now, the thing that seems to move commodity prices the most is whether they're discussing a ceasefire or peace agreement. When that seems likely, prices seem to be falling. If the war is escalating or Black Sea port damage is occurring, that tends to increase prices. So, as you're listening to the news, something to keep in mind about what direction prices are likely to go, just based on what you're hearing the conversations being. As we looked at in the budget, even with higher fuel and fertilizer prices, commodity price improvement has largely offset those input price increases. So that's good. I think the 2 takeaways here are, 1, producers are going to need to set some type of price. It's hard to do it right now. There's a lot of upward momentum in commodity prices. And so maybe we don't have to do anything today, but producers really need to be watching these markets and be prepared to lock in some prices at levels that are profitable for them. Probably the more important thing is producers are going to need average yields or better in 2022. The concern we have is that with these higher input costs, if we have a drought or yield reductions, the potential losses are record. If we make a 75% corn crop, we could really lose a lot of money in corn in South Carolina this year. So that's something else we need to keep an eye on, is what the yield outlook is once this crop gets planted and we move through the growing season. It's still important that we think about South America. They're a big exporter of both corn and soybeans and cotton. And currently we're still expecting downward yields for South America. And it's going to be interesting to see if the U.S. can capture some additional soybean exports as a result of that. Coming up at the end of March is the USDA's prospective plantings report. That was based on surveys done the first 2 weeks of March. And what I like to do is kind of think about, well, what could happen? And so to summarize what we're watching is, for every 1 million acre in planted acres change, we'd expect our ending stocks to use ratio to drop roughly 1.2% for corn. So if we have a 1 million acre increase in expected corn plantings from 92 million to 93, we would expect our ending stocks to use ratio to go from 12.6 to 13.8. Whenever that number gets bigger, prices tend to decline. So it's going to be interesting to see what happens on these acres if the current turmoil and disruptions and price changes have influenced the planting intentions this winter. And one thing that I hate to talk about, but we need to watch, is just what interest rates are doing. Last week, Fed announced a 0.25% rate increase, and now the prime, for the first time in many years, is being reported at 3.5% instead of 3.25%. This chart just showing you what's happened on the commodity prices in the last couple of months. As you can see, corn has been on a trend line up from end of January. It was at 570, and we're up $1 today at 670. It's been pretty consistent. Most days have been higher. Soybeans, on the other hand, started off at 1350, got as high as 1480 or so, and then they kind of just leveled off there until this past week. And now we're seeing a little bit of a rally, since Monday in soybeans, and we finally broke through the $15 mark on November 22 soybeans. Cotton started the year off strong, went as high as $1.06. Then it kind of fell off in between the middle of February and last week, traded in a $1 to $1.04 range. But last Friday and continuing this week, we've seen another bump in cotton prices up to $1.08 a pound, which is very encouraging if we can lock some of that in. And then finally, wheat's been the most volatile crop. We were below $8 for the first 2.5 months, but as soon as the Ukraine war started, saw a rally up to 9.25 as the tensions got higher. Once they invaded on the 24th, you can see there was a drop in wheat prices. Then they rallied back higher, all the way up to $12.75, and then since then fell back. Currently, we've seen a short-term rally, and currently wheat on the futures market is trading for $11.25 against July. But again, it's a difficult market to actually make cash sales in. Most of the buyers are switching to September or December rather than trading on July. So one of the things you like to say is, well, what should a producer do? And so what I'm showing here is just kind of a schematic that says, well, what if I buy a put option? And these are just looking at buying put options at the current market price and kind of what that would cost and what kind of protection would that give a producer. So you could buy a September 2022 corn put option. At the money puts would be a 680 strike price. It's going to cost a whopping 69 cents a bushel to do that. It would give you a floor price of $6.11 plus your basis, so you'd be close to $7 cash price. Just need to look at your cost of production and see if having a minimum price in the $7 cash range is profitable for you or not. If you were to do that on 100% of expected yield, which I'm using 125 bushels, costs you $86 an acre. Hopefully you have some working capital that you can use for that, but it would be difficult to do 100% pricing on something like that. So these others are for soybeans. Other examples using the same idea for soybeans. A $15 put option would cost you $1.16, giving you a floor of just under $14. For cotton, it would cost 11 cents a pound to buy a $1.08 put option, and the floor would be 97 cents. You probably think back to how many years you wish you could sell cotton for 97 cents. But anyway, spending 11 cents to do that was the problem this year. Wheat, an $11, close at $11 put would be $1.15, give you just under a $10 floor on wheat. So you could think about that, or I would probably use this last comment for my marketing in the near term. I could consciously do nothing. And that basically means that, right now these markets are in strong uptrends. It's been paying to do nothing at this point, but you need to have a plan to do something when these markets turn. So at this time, we're going to open it up for some questions, if you all have any on anything that we've shared. And
We do have one question on here, and what's the downstream impacts on the protein production due to the feed grain prices? And we are seeing costs increase for those in the protein markets, whether it is dairies that are reliant on purchasing their feed, the poultry industry, and the hog industry. We're also beginning to see that there's an increase in placements on feedlots. And it's believed that some of that placement globally is or nationally, I should say, because some of the drought conditions that are taking place out west. I think California has already started telling farmers that we may have to shut off your access to water earlier than anticipated. And so if that continues out throughout the West and those areas that we're seeing drought, we're going to see more placements moving into the feedlots, those higher costs coming down. So depending on what part of the chain you're in, and then here in South Carolina, there is a section of South Carolina that is in a slight drought, but regardless, feed prices are going up. That's going to narrow the profit margins for any of our livestock producers and dairy producers right now. So, but there's a few other things that might be playing a role in it. And we all know that although prices might go up at the grocery store, the farmer may not necessarily see those same profit margins, because although they might be receiving a higher cost or a higher price for their product, the input costs are essentially negating some of that higher commodity price. So we are watching that, but it's that's going to continue to happen, and so those guys have to really watch their numbers. Scott, Nathan, anything to say on that question?
no.
Another question came through for you, Scott. Scott, are any of the input costs in the enterprise budgets adjusted for inflation?
So the input cost in enterprise budgets, the fertilizer, chemicals, and fuel prices have been updated for the change since November to February. So if nitrogen went up 18%, I increased the nitrogen cost 18% on all the budgets that were shared this morning or this afternoon. As far as the chemical cost, I used a 10% increase across the board. The one thing that has not been factored in is actual trucking costs for hauling grain to the market. I did not update that, although based on fuel costs, we could expect, a 20 to 30% increase in freight rates for shipping grain from the farm to the markets next fall.
Scott, I will bring this up just because I was on the phone with a farmer who was trying to sell a load of cattle, and they were trying to find a truck. They had a difficult time trying to find a truck and driver, and the prices that they were being quoted. Now, this is for cows leaving the state of South Carolina, heading to South Georgia. They have been quoted now upwards to $5 a mile.
Yeah. That's going to be, truckers have their choice of where they want to haul and what they want to haul. And, I think that's going to be an ongoing problem, is just lining up transportation and freight.
And for some of those that are on, but may not be directly related to row crop or even the livestock market, but even little things, specialty crop. A lot of our specialty crop growers use plastic. The production of plastic obviously there's some petrol that gets used and other utility costs in there. And those prices for that plastic has gone through the roof. I'm hearing some prices anywhere from $350 to $450 an acre for some of that plastic, depending on if I need it for quality level of for fumigation purposes, or if I'm just doing a 2-ply being put down and those types of things. And the biodegradable plastic, I think the most recent number I heard was running $525 to $550 an acre. So, Scott, are there some marketing opportunities here? You started going down that path talking about options. What are some potential opportunities for at least our row crop guys right now?
I think it starts with knowing what your cost of production is, what your debt service load is, and just having an idea of what kind of price do I need in 2022 if I make my expected yield, and what if I make 80% of my expected yield? What kind of price do I need? Right now, there's no reason for prices to drop, but that's usually when prices do, is when we're not expecting it. So I think you have to look and see what's available. In talking with some people this week, some of the harvest delivery corn markets are stating that they're full for harvest delivery. Whether that means they're full of 7+ corn, or whether they're truly full and don't have room for any more corn at harvest, I'm not sure. But if you need to ship corn at harvest, you need to be talking to buyers, because that's really going to be key. If you were to cash forward contract anything right now, that does eliminate any margin call risk. If you think prices could still go higher, you could always cash sale and buy some calls out of the money to open up the upside. But at the end of the day, just look at what today's price is, compare it to what you need, and start getting 10% or 25% of your production covered.
So, and Scott, you and I talked earlier today, and we brought it up here in the presentation. So if I'm a farmer, I'm expecting to put in, let's say, 1,000 acres of crop X, and then I'm told, or I figure I can't afford to fully apply all the nutrients necessary. What route should I really be going? What should I be thinking? Should I reduce my acreage, or should I go light on my fertilizer application?
As I looked at the budgets and some of the soil test recommendations on fertility, it appears to me that economically, your best bet is going to put down the fertilizer that you need for your expected or type of land you have, and fully get as much as you can out of each acre. Because some of the costs are going to be the same whether you plant, per acre, the same, but it looks to me like you'd have more profit planting 750 acres of corn using recommended fertilizer rates than trying to produce 800 acres corn at reduced fertilizer rates. I just think you're better off to match up your fertility, meet your fertility needs as you can.
So essentially, if I have to reduce acres to be able to have the full recommendation of fertilizer to be applied, is probably going to be more economically efficient than trying to go with less and reducing my yield per acre.
Yes, I think you're better off to apply the correct amount on smaller acres and a lesser amount on more acres.
Okay. And now this, I've got a question, since nobody's asking this one, I'm going to ask Nathan this one. So Nathan, and Scott, chime in as well. What should we be expecting for ARC PLC this year? Because that's going to be every row crop farmer's question mark, right? Because I see all these higher prices. I shouldn't expect it, but I've got all these extra input costs that kind of took us by surprise.
Yeah. And just as a reminder, ARC PLC, we're still working off the 21 season average price. So if there is any, it would be small. Peanuts will still have one, but it may be half of what we've been getting in previous years. But for 2022 crop, with these prices, there will be, Scott covers the corn and soybeans, but we're well above reference price, and the ARC benchmark guarantees are low, as low because of the Olympic average. So don't expect any ARC or PLC payments except for maybe peanuts.
And this really brings up the issue with it's a policy question, really, right? When these things were kind of derived, everything is purely based off of price, not necessarily the cost to be able to raise the product. It's, am I getting the yield off this particular field? And that kind of sets the base for some of this, right? It doesn't really help us when we have high commodity prices, but our input costs are just as high.
So it's a deferred help. I mean, if we can keep
Right.
prices at these levels for another year or two, maybe the 23, 24 or the 24, 25 crops may get ARC PLC prices, even though prices decline and input prices decline. But we really do not want to trade current market prices for an ARC or PLC price. Because if we start collecting ARC PLC prices in the next year or two, we're really in bad shape from an overall farm profitability standpoint.
All right, and then Trey, I believe, or a question came in. Are land prices impacting dry land rent and irrigated rent values? If not, will farmers face an increase in 2023 for this?
Can you repeat it?
Repeat that
Adam?
question?
We didn't.
Yep, are
Didn't quite
land
hear it all.
prices impacting dry land and irrigated rent values? If not, will farmers face an increase in 2023?
Mhm. Dry land rent.
So that's a yes or no question. So the easiest way to do this is say yes, it will impact. But that's probably not what he's asking. I think land rent in South Carolina is really a negotiation between the landlord and the tenant. And I think in some places you may see some increases, but in other places you may not because of these higher input costs. Some of the landlords may not necessarily go up on rent because I know that the margin may not be increasing. So it really comes down to a personal conversation between the farmer and the tenant, or I mean the landlord, in my opinion.
I would agree with that personally, and where I have seen or heard of rents going up, it's kind of a one-off when the right chunk of ground has come up or has become available because of a farmer retiring or a change of life activity, and the neighbor really wants to make sure they're able to lock in that land to be able to have access to it versus somebody driving 2-3 miles down the road with their equipment to get to it.
From a theory standpoint, I guess, economists coming out, the land rents, the excess rents or profits from farming get bid into land over time. And really, we're seeing high prices, but we're seeing high prices on both sides at the same time. And so I don't know that the profitability that we will see the competition for dry land just because of these higher prices that would generally drive up those land rents. But
And that would
some
be
folks
some
may
of
want to
the-
adjust because they see the high output prices, but
I
I'm
think,
not.
and I think one of the differences in South Carolina compared to a Midwest is that so often our land rent includes land that's not productive. It may include some woodland. It may include cleaning a ditch or maintain. I mean, there's other things other than the productive farm land included in our rents. You get some small fields, a 5-acre field, which is not economically a good size. And sometimes you have to rent that to get the 50-acre field. So there's, in Midwest, where I can just rent 160 acres and not have to do anything but farm it. I agree with what Dr. Smith's saying about how that rent would change, but there's a lot of other factors that determine South Carolina land rent.
Well, I mean, we have in parts of our state, we have a lot of land that is essentially rented for, as long as somebody's willing to mow it and keep it up, it's yours, and that's all you got to pay. And there's a lot of variety here in this state as well with regards to the productivity of the land and land use itself, which helps complicate some of these types of questions. All right, and I threw up the very last polling question. So we had Jonathan Croft made a statement here. A lot of landowners have called extension offices this year wanting to know what land rent is or should be. And I know many of us have been getting those questions, and and especially the agents know very well that it's really difficult to go ahead and say, all right, even though my county might be averaging X, your piece of property might not be able to receive that same value because of size, shape, location, whatever else it happens to be. And right now, the data that we get from the USDA is very, very general and very, I'm hesitant to even hand that out to anybody. Because it's such a localized question. There's a couple of equations that can be done based off the value of land itself, but I'm not necessarily advocating that ought to be done here in the state of South Carolina, because I just don't think that works because of there's some farmland just up for me right now, $18,000 an acre to $25,000 an acre. And based on the productivity of that land, it still wouldn't bring that high of a rent if you were to follow through with some of the business equations that would be used to determine what the land rent value should be.
Adam.
Yeah.
All right. We're at 1 o'clock, and
It's time to go.
we had agreed we needed to bring up, but as we've talked about the changes and disruptions that have occurred in South Carolina ag this winter, we just want to mention that there could be a lot of stress either from farmers, from their suppliers, other family members or whatever. And we just want to make sure that you're aware that the, shoot, can't get to it. Well, I was going to show you another slide that had the, there we go. In partnership with Clemson University Agribusiness team, the South Carolina Farm Bureau, South Carolina Department of Ag, and can't think of the fourth partner, Adam, but just want to make you all aware that we do have the South Carolina Agri Wellness to help. It's a free counseling service for farmers and their families, where people can call in and be connected with a trained mental health professional. All you have to do is call that number on the screen and just reference South Carolina Agri Wellness to receive that. So we wanted to wrap up, but I just wanted to point out that, and we'd be glad to answering questions that you may have if you still want to stick on. But we appreciate your attendance today, and hope that we can continue to do this each month.
Yep, I will follow up, Scott. The other group you were trying to think of was First Son EAP. And just so that those that are on understand, when you call that up, there is a crisis counselor on that other line, but you're able to receive upwards to 3 free counseling sessions with a professional mental health expert. And you can do that in different methods. You can do that through texting. You can do that over the phone. You can do and choose to do that virtually or in person. They will help you. I hope you find the person nearest you and that would be a good fit for you. If there's any other questions, we're willing to stay on to take them. I will also say Jeffrey Elliott, he says, I hope I can go to school again for ag. Looking forward to seeing more from all of us. Thank you, Jeffrey. We hope that you'll be joining us on with some of our other programs as well. And with no other questions, thank you all. Have a good day.